Have you been working on improving your credit scores for a very long time, or you thought you have been doing everything you could right and your credit scores just still go down? Or you hired a credit repair company and you wake up one morning and your scores randomly dropped out of nowhere? Find out in this episode on why your credit score may have changed. Sturgis Credit Repair is a 5-star rated online credit repair company. We help people just like you build or rebuild their credit scores. If you have no credit history, we offer products to help you build credit history so that you never have to depend on anyone co-signing for you. If you have bad credit, enroll into our service today and allow us to work on the negative items affecting your credit scores. We take no money up front, so start our service today for free. You'll get updated through your online account as well as receiving updates through your email. For those who are trying to buy a home, we're partnered with multiple real estate agents and loan officers who are ready to assist you with your goals. If you are a real estate agent, loan officer, or anyone dependent on customers with good credit, create a free partner account with us today. You can manually send or receive clients through your online account as well as track their progress before they go to someone else. Visit our website to learn more about our services. So let's talk about why your credit scores may randomly drop out of the blue sky. I get hit with this one a lot since I own a credit repair company. A lot of people sign up for our credit repair service and they may do something wrong or they just randomly see their score drop out of the blue sky, and the first thing they do is reach out and say, hey, did y'all make my credit score drop, or why did my credit score drop? Sometimes this can get annoying for two reasons. One, people just automatically assume since we're working on their credit report, we can report information to their credit reports, therefore we made their score drop. Well, credit repair companies aren't banks. We don't report to your credit report. It is 100% impossible to make somebody's credit score drop because we don't report information to their credit scores or to the credit bureaus. Only banks can drop your credit score, and you, of course, if you don't pay the banks. But the second thing that gets annoying is if we tell somebody not to leave balances on their credit card or not to go out and apply for new accounts and add new inquiries, or not miss any payments, and they go out and miss these payments and they reach out, oh man, why my credit score dropped? Well, you did it. So those two things can get annoying. Now, for people that truly have no idea why their credit score dropped, and it may be because some of the things I may explain later on in this episode, that's a different story. That's understandable. But only when people are just, believing that a credit repair company dropped their credit score and, instead of helping them, a lot of that stuff can get annoying because it's impossible to do so. So let's get started here. Number one, the main thing that can drop your credit score is a recent late payment. So if you missed a payment on your auto loan, you missed a payment on your credit card or any type of personal loan, well, this brand new late payment can drop your score as much as 60 points, 80 points, 100 points, I'm sorry. I've seen it personally with my own eyes where somebody's credit score literally dropped over 100 points from one recent late payment. Now, they may have not had much in their credit reports, therefore one negative account has really impacted their credit scores. But yes, missing a late payment, that can cause your credit score to drop. Number two, a collection or charge-off account, which means previously you had an account, you never paid it. Now this creditor is reporting it to a third-party debt collector to collect the debt on their behalf. Or you had a hospital bill you never paid. Now the hospital contacted this debt collector. They're reporting this hospital bill to your credit report. Same thing with utility companies. They don't report to the credit bureaus. However, they're going to hire a debt collector to report this information to the credit bureaus. So a collection account charge off, this can drop your credit scores the same amount as these late payments here. Number three, now this is coming more on the side of people not knowing truly why their credit score have dropped, and this is more understandable. So if you watched or listened to our previous episodes, whenever you close out an account, it still reports for 7 years. But whenever that 7 years comes up from the date that you close the account, that information is deleted. It falls off your credit report. It's old, it's history, it's dirt. So even if you made 20 years worth of payments on that account and you built your credit score is up to 800 from 20 years of credit history. Well, once you close out that account, 7 years from that date, that account falls off. So you have lost all of those payments. You've lost all of those months of history that you have made on that account. So a lot of times people wake up, their credit score drops 60 points, and it's literally due from their credit age changing. Something old have fell off of their credit report that was really helping or really have built their credit scores in the past. So if an old account falls off, old positive account falls off, it will drop your credit score if you are not continuing to build your credit scores. Number 4, credit card balance. This one is important. So a lot of people, they go out, they get these credit cards, they max them out. Well, a lot of times they don't understand that credit card balances report to the credit bureaus, and they just think as long as they're making on-time payments of the $25 minimum payment, they're good. Well, the payment due date has nothing to do with credit reporting. That just determines if you're being charged interest or how much interest you're being charged on unpaid balances. For example, if I had a credit card with a $500 limit and the bill came in the mail and it said, hey, Chris, you spent $500 on this card, just make this $25 minimum payment and your account will still be in good standing. You don't have to pay us back the $500 right now. The reason why they tell me that is because if I pay $25, I still owe $475. Interest on credit cards is like 25, 26, 27%. It is super high. So they're making 20+% interest on that $475 that I did not pay back. However, since I paid them a $25 minimum payment, I'm good. I'm not going to have any late payment on my credit card account. And a lot of people get stuck with just making that minimum payment or not paying their card off in full, and they get charged interest on those balances, and credit card debt just start happening. A lot of people say, oh, credit cards are bad. Credit cards put you in debt. That's because you put your own self in debt. You spend money that you can't pay back. So the way to use a credit card, use it, swipe it, pay it off in full by the due date. However, like I said, the due date has nothing to do with your credit report. It just determines if the bank is going to make interest off your unpaid balances. Now, after the due date, about 3 to 5 days after that due date, check with your bank. Every bank is different. You have the statement closing date. That's the date that the bank reports your current balance to the credit bureau. So it doesn't matter if you paid the card off in full on the 15th. If you go right back on the 16th, max it out, and then on the 18th, they report it. They're not going to report that the card is paid in full if you went right back and used the card. So you have to keep that card at 0 until after the statement closing date, because on the statement closing date, they report that information to the bureau. So any balance that is reported to the credit bureaus is going to drop your score. It doesn't matter if it's 5% utilization or 6% utilization or 2% utilization. Any utilization or any balance reported on the statement closing date is going to drop your credit score. And a lot of times people max their cards out, make the minimum payment, and they're having 95% utilization reporting to their credit reports, and their score drop 150 points easily. So number 5, new inquiries. When people go out and apply for all of these cars and all of these credit cards and loans out there, well, a lot of times you go to a car dealership, you sign one credit application. Well, that one credit application is to run your credit through 30 different lenders. Each time someone checks your credit report, it can drop your score as much as 2 to 5 points per inquiry. So if you go to one car dealership and they run your credit to 30 different lenders, well, you take 2 points times 30 lenders, that's 60 points in inquiries right there. So be careful how many times you run your credit. Number 6, last but not least, new account. Let's just say somebody had perfect credit. They never missed a payment. They never had any type of hospital bill, utility collection account reported to their credit reports. They wake up one morning and boom, their credit score drops 20 points. That's because a new account has, hit their credit report. Maybe they apply for something. It finally hit their credit report. And what happens is it shortens their average credit age. So let's just say if somebody's been building credit history for 10 years and no new account has reported to their reports, well, that's 10 years is their average credit history. So you take 10 years And now you add this one account on there, where that 10 years is going to turn into 5 years average credit history, because it's going to cut that 10 years in half. So it's just an average. Credit history is reported on an average. It's not reported, let's say if I open up an account 10 years ago and started building credit, and I open up a new account every single year from 10 years ago, that doesn't mean I still have 10 years of credit history, because my oldest credit line is 10 years old. It goes by an average. So if I, had 2 accounts, one account was 10 years old, one account was 5 years old, that may be an average credit history of 7 years or somewhere in that range. So it's just an average age of credit history. So those are all 6 possible reasons why your credit score may drop. I don't think there's nothing else out there, because that's all possibly could, happen to your account or to your reports. Out of all 6 of these, all of them isn't really negative. So a new account being reported isn't a negative thing. New inquiries, that's somewhat of a negative. I mean, they report for 2 years, and most people don't really worry about inquiries too much. Credit card balance, I want to say no, that's not a negative thing, because you can just fix that the next reporting date. So next month you can go right back and fix that. And then last but not least, old account being removed. That's out of your control. You closed the account 7 years ago, and now 7 years later the account finally falls off. So the only thing you need to worry about is not missing any payments, not making any new collections, getting on there. And like I said, this is somewhat not a negative thing. You want to just make sure you're not applying for too many hard inquiries out there. So that is all with this episode. This is all 6 possible reasons why your credit score can go from a 740 to 560 just overnight. So hope you learned something from this. And as always, ask questions if you have more questions, or if this episode didn't answer all of your questions. Thank you. If this video helped you, be sure to like it, comment, share it, and subscribe to this channel for more helpful videos like this one. Thanks for watching.